There's a couple of different things that we look at to try to identify this. The first is we start with our uniform accounting numbers. One of the big things we do here at Valens is we restate the financial statements to get rid of all the problems that you have with GAAP and IFRS accounting and understand what real corporate profitability is and what real corporate earnings are. The next thing that we focus on when trying to identify what companies are at risk is really honing in on debt maturities and debt obligations. When you have a better understanding of what debt obligations are for a company and where they fall, you can understand when companies are going to have to make tough decisions. And the names that we've highlighted here, these 9 have debt maturities in the next couple of years, specifically the next 1.5 years or so, that may, if they're closed off of the markets at all for any moment, make them have to make tough decisions, and the dividends might be part of what's on the chopping block.
Okay, one thing that surprised me about your list was we're looking at 2 generals, General Mills and General Dynamics. That includes also a number of other food companies, and what's surprising, Campbell's and ConAgra and Kellogg's. And I guess, all we hear about is the food companies booming right now, Robert, because everybody was stocking up. Why did these companies make your list?
Great question. Right. The goal of this list isn't to find companies that are actually imminent risks of dividend cuts right now. It's to find companies where these are blue chip names you just mentioned, right? But the issue is you're being undercompensated if you're an investor for the risk for these companies' dividends if you're owning them, right? If you look at a name like General Mills with a 3.5% or so dividend yield, you're looking at a name where the market isn't pricing any risk of a dividend cut. But when you look at the company, it's got $3 billion of debt coming due in the next year and a half. It's only got $600 million or so of cash on hand. And if they have any moment are actually cut off from the credit markets, so they can't refinance that $3 billion of debt, if we have another leg down per se, well, you're going to be in a situation where they're going to have to make some tough decisions between cash flows and cash on hand. What obligations between debt maturities, interest expense, dividends and capex and other things are they going to actually spend money on? And the dividends might be something on the chopping block. And at a 3.5% yield, the market's not pricing that risk in.
Yeah, you got John Deere on your list as well. I mean, you think about sort of a company that is globally exposed to so many different trends, not just lockdowns, but supply chain issues, and of course, food hoarding, and then not enough food here or there. John Deere, what's their situation, and what's likely to happen to their dividend?
Yeah, of course. The first thing that jumps out for John Deere is obviously when we talk about those debt issues again. A lot of their debt is obviously in their financial subsidiary, but they have $7 billion coming due in the next 2 years. And the other issue with John Deere is when we think of John Deere, we think of tractors, right? And we think, oh, okay, you know what? Farmers are probably still doing relatively well because we're still eating. Right. But the reality is a third of their business, I should say, a third of their profitability comes from construction. Right. And nobody's really spending money in terms of buying new construction equipment right now. And if you think about that environment and a company that's got plenty of debt coming due and may need to make tough decisions, it's, again, a company that we're pointing out and saying, look, you're being undercompensated for the risk here. And if there are any cash flow or access to credit issues, that's going to be one of the first things on the chopping block.